If the United States were to ever default on its debt, the world economy would implode within 48 hours. Banks would freeze. Markets would crash. The value of every dollar in your pocket would evaporate. Welcome to the It's Financial History 2, where money, power, and history intersect in complex ways. What we label as U.S. debt is far more than a figure on a balance sheet. It is the very bedrock of our modern world. It's the invisible framework supporting everything from your home loan to the price of groceries. If that foundation were to fracture, the result would be more than an American crisis. It would be a global collapse of faith, signaling the end of the financial system as we know it. But to comprehend how such a fall could happen, we must first understand how this towering structure was built. How did the richest nation in history also become the most indebted? The story begins in 1790. A young nation, freshly independent, was drowning in war debts. It owed money to soldiers, citizens, and foreign allies. While most nations would have defaulted, Treasury Secretary Alexander Hamilton made a radical choice. He embraced the debt. He argued that, by borrowing and repaying reliably, America would establish itself as trustworthy as safe bet in a world of faltering empires. Hamilton's gamble paid off. The U.S. began issuing bonds promises to pay and, crucially, it honored them. Investors responded with confidence. In European markets, American debt became a premium asset. The Republic had not only won its freedom through war, but had financed its future through faith. That faith became the cornerstone of American power. Every major growth phased: the railroads, the Industrial Revolution, the New Deal. World War II was funded through borrowing. Debt was not a weakness. It was the engine of expansion. By the mid-20th century, that engine was powering the world. In 1944, with World War II still raging, 44 nations met in Bretton Woods, New Hampshire, to design a new economic order. Their historic decision was to anchor the global financial system to the U.S. dollar, which was in turn backed by gold. This meant the world's major currencies now depended on America's promise. Post-war, the U.S. held 2/3 of the world's gold and half of its industrial capacity. Confidence in the dollar was absolute. Foreign governments stockpiled dollars as reserves, and when they sought a safe investment, they bought U.S. Treasury bonds. American debt had become the world's savings account. But systems built on faith are not eternally stable. By the late 1960s, the costs of the Vietnam War and expansive domestic programs were draining U.S. gold reserves faster than they could be replenished. Other nations began to demand gold instead of dollars. Then, in 1971, President Richard Nixon made the most consequential financial decision of the century. He severed the dollar's link to gold. Overnight, money was no longer tied to a physical commodity. Its value now rested entirely on confidence and the U.S. government's promise to honor its debts. This created the system we live under today, the debt standard. The dollar was no longer backed by gold, but by the world's trust in U.S. Treasury bonds. It was a silent revolution. The United States could now create near limitless credit, provided the world continued to believe in it. Treasury bonds became the planet's safest asset not because they were without risk, but because everyone agreed to treat them as such. Banks used them as collateral, pension funds relied on them for stability, and central banks filled their vaults with them. So, when you hear about the national debt, you are not listening to a story about a bill that must be paid. You are hearing about the core infrastructure of global finance. Every loan, derivative, and credit card interest rate is built upon the foundation of U.S. government debt. The system depends on a simple, perpetual ritual. When old bonds mature, the U.S. issues new ones. The debt is never truly repaid. It is rolled over forever. As long as this cycle continues, the illusion of stability holds. But if that chain breaks, if the government misses even a single payment, the illusion shatters instantly. Treasury bonds are the collateral underpinning the global banking system. A default would mean the risk-free asset is no longer safe. We have seen previews. In 1979, a mere processing glitch that delayed Treasury payments for a few days caused interest rates to spike, with effects that lingered for years. In 2011, a political standoff in Congress that nearly prevented the debt ceiling from being raised led to the first-ever downgrade of the U.S. credit rating. Trillions were wiped from the markets not due to a financial crisis, but a crisis of psychology. The entire global economy is built on one assumption, that the United States will always pay. This has turned debt into America's most powerful export. Other nations trade in goods. America trades in promises. Each bond it issues becomes part of another country's reserves, another bank's safety net, another pension fund's stability. This is the great paradox of American power. The U.S. does not need to eliminate its debt, it needs to maintain it. The world demands it. If Washington ever tried to pay everything off, it would collapse the very system it sustains. Debt is no longer a liability, it is the product. Yet even the strongest faith can crack. U.S. debt has soared past $38 trillion. The annual interest payments alone are nearing $1 trillion, almost equivalent to the defense budget. The government is now borrowing money to pay the interest on money it has already borrowed. The machine still works, but the strain is growing louder each year. Political brinkmanship has turned the debt ceiling into a recurring hostage situation. With every congressional threat of default, investors grow nervous. Foreign buyers like China and Japan have begun to slowly reduce their treasury holdings. Central banks are quietly buying gold again, and countries from Brazil to India are exploring trade systems that bypass the dollar entirely. For the first time in half a century, the world's faith in U.S. debt is showing fractures, not because America lacks money, but because it lacks political consensus. In a system held together by trust, politics becomes the ultimate risk. What happens if the United States fails to pay isn't just a question of dollars, it's a question of belief. And belief, once lost, is the one currency no government can ever borrow back.